We want to head to Yahoo Finance's Julia LaRoche. She's been sitting with Troy Gayeski, SkyBridge partner, co-chief investment officer and senior portfolio in honor of SkyBridge Investment's 15th anniversary. Julia?
Hey, that's right, Adam. And Troy, thank you so much for joining us at your 15th anniversary at SkyBridge.
Yeah, it's great. It's been 15 years. I mean, our investment team came over 10 years ago. So we're very pleased to be a part of the SkyBridge's growth over time. And obviously, over the last 10 years, we've been in many different market environments. Eurozone crisis, the 15-16 dislocation in China. Now, unfortunately, we're going through the coronavirus scare.
Yeah. Let's dig into that. I want to hear your thoughts on the coronavirus and what do you think the scenarios are that investors should be paying attention to?
Yeah, so basically, when you think of the coronavirus as it impacts markets, the reason markets are so volatile right now is you have such extreme outcomes, right? On the one hand, it's very easy to see a situation where we have at least a mild recession in Q2, Q3, and you have a mild to severe bear market. And by what we mean by that is somewhere between down 30 to 40%. You see the cascading effect, right? At some point, you'll see initial claims start to go up, unemployment track up, essential consumer spending drop dramatically, business investment drop. So that is a very bad outcome. On the other hand, you could see an outcome where the potential for spread is lower, the fatality rate is lower. There's overreaction from government officials. The Federal Reserve's cut by 50 basis points. Maybe they cut by another 50. They start expanding their balance sheet. The Trump administration and Schumer and Pelosi get together and do a fiscal stimulus. And then we look back at 6 months, and things were not nearly as bad. And then you have explosive upside. And then from an asset allocation standpoint, you see how the outcomes are very different. If we have the bear market, it's going to be horrific for equities, but fairly good for fixed income. If we don't have a recession, very hard to make money in fixed income. And if we get that right tail outcome, say 6-9 months from now, very tough to not lose money in fixed income, and you need to hold on to equity exposure to capture some of that upside. And so when you're thinking of these day-to-day moves, as an investor, remember this is what the market's trying to grapple with, right? The broad uncertainty, reasonable risk of recession, reasonable risk that this thing blows over. Very hard to price in. So that for the time being, what we see investors doing is principally trusting asset allocation. The whole point of having a diversified portfolio in equities, fixed income, and hedge funds as one alternative is to hit a reasonable return goal and have dampened volatility. What many are starting to do is peel off some fixed income risk because you've had such a run in the 10-year and the 30-year. And on the margin, start to look to re-enter some hedge fund exposure or some exposure in the equity market itself.
Well, there are a couple things I want to unpack here. You just brought up the 10-year. And now we've seen the yield. It's below 1%. What sort of signal is that sending to you? What do you make of it? How are you navigating that?
Yeah, so I think it depends on the instrument. So, for instance, in our portfolios, what we're favoring now are instruments that will do better, all things being equal, in a lower for longer regime. We've been doing that since the Fed started to pivot last year. Again, last January, we didn't know the Fed would cut 3 times, but by the summer, that was the track they were going in. So that means more RMBS securities, more CMBS, things that benefit from lower rates. At the other end, obviously a lower 10-year means more volatility, more dislocation, because the reason the 10 years is low is because of the economic uncertainty. So there we're ramping up convertible bond arbitrage, which is a strategy that can help monetize realized volatility. But make no mistake, if we fall into a recession, the 10 years going much lower, our target 3 years ago in an instantaneous recession was a year. Now it's 50 basis points. I think you could also make a good argument it could go below that. But just remember, it's only going to go there if we have a sustained downturn.
Right.
If we can avoid economic damage, which is still very much a reasonable possibility, you're going to get brutalized if you have too much duration on.
Well, you mentioned it's a reasonable possibility. What do you think, though? Do you think we will be able to avoid that? Because it sounds like y'all are pretty defensive right now.
Yeah, so from our standpoint, remember the role we fill in a portfolio. It's to grind out mid to high single digits. And we've been in a late cycle where equity multiples are the highest they've been since the internet bubble, right? And that doesn't mean they can't go higher, of course. But given the role we serve, that is the strategy we've been pursuing. When you think about what outcomes would drive us to get more aggressive, if we have that bear market, we have that recession, we have the down 20 to 25 in high yield, if we see corporate defaults start to peak, that's when we'll go more on offense, and we think we'll particularly go after distressed credit, because that is the next great hedge fund opportunity. There should be at least $400 billion of defaulted securities and well over $1 trillion of distressed securities.
I want you to unpack that for our viewers, because you just said that's the next great hedge fund opportunity. We've heard other folks bring this up. Unpack exactly what you're looking for there.
Yeah, so when you think of the way credit cycles play out, whether it's in credit markets or equity markets or currencies, the area that has the most excess in the good times tends to get punished the worst when there's a downturn. So, you think back to the late 90s, there was excess in corporate credit and in equity valuations. You had a horrific bear market for both. You had 23.8% cumulative default rates in high yield, and the GDP only contracted by 0.7%. When you look at the financial crisis, where was the excess? Housing, to a lesser extent CMBS, high degrees of bank leverage. Those sectors got hammered, and that created great opportunities coming out of that. So when we look at capital markets today, leverage levels have continued to go up in corporate America, both in terms of debt to GDP, debt to income, debt to EBITDA. When you look at the underwriting standards, how badly they've deteriorated, what it will take to create that opportunity, though, is a downturn. So unlike the perma-bear crowd in high yield that's been calling for high yield to collapse for the last 5 years, we've been watching, and we're 90% sure that when the recession hits, you'll get back up to that 20% cumulative default. So what that means is 20% of the high yield bond market will more than likely default. That will create ample supply for hedge funds and private equity managers to go after and restructure companies coming out of bankruptcy.
A lot seems like it's changed in the last week or so, and especially when you're talking, you bring up recession and what that looks like, the probability there. Do you all have a view of when that could change, or what your expectations are for one?
Well, again, back to, it was all similar to your previous question. I think you can't proceed with a false sense of certainty, right? So, there is various commentary over the severity, the R0, the fatality rate, a lot of moving parts. From our standpoint, it looks more like it will be a more severe flu. It will be widely dispersed. Most people will be fine. But the economic slowdown could be significant in Q2 and Q3. So right now, be prudent, protect capital, and get ready to go after the dislocations. If they don't occur, that's fine. We'll make our mid to high single digits. If they do materialize, then we can put up much bigger numbers.
Be prudent. Troy Gayeski,
Yes.
Co-CIO of SkyBridge Capital. Thank you so much.
Great to see you, Julia. Yeah.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.